Okay, good evening. Tonight is Tuesday, April 2nd, and I'm going to do chapter 22 on leasing. It's quite simple. We should be done. Shouldn't take the whole class. Group assignment 2 was I posted it on Saturday because the course supervisor wanted 10 days max. Anyway, so I put it on Saturday, but I got an email from her today with some changes. I'll write them on the board. Okay, so we're talking about assignment 2. For problem 1, and for problem 2, so life of the bond is 10 years. That's our first change. And for problem 2, assets value So to recap, I posted assignment 2 on Saturday, and just got an email from the course supervisor. She makes 2 corrections. Problem 1, life of the bond debt is 10 years. And in problem 2, the assets value under the proposed capital structure is 15 million. And not 10 like it was stated before. So I just got this email this afternoon, so I'll make the changes to the question paper. I'll repost it later this week, but at least you have it already now here. So group assignment, the quiz 4 was went through the Scantron, and the results are posted on CU Learn. The final exam is April 26th. And so any questions at all about anything course related? No? Okay, so let's get started. So tonight I'm going to talk about leasing. It's a fairly simple chapter. There's only really 2 mathematical problem types in here. The first one is we're going to do this thing called net advantage to leasing in lease and buy, and also the break-even lease payment. But the rest is mostly qualitative knowledge or pretty simple stuff. It's not that complicated. This is one of the easiest chapters in the course. Together with chapter 17 and 22 are the 2 easiest chapters in the course. So what's a lease? It's a contractual agreement for use of an asset in return for a series of payments. So I think the one that you're most familiar with is if you live in an apartment, you got to pay your rent every month. So you're leasing the real estate. You're not actually owning it. The lessee is, now this is just a little bit of vocabulary. Lessee and lessor. Now these endings of e and or, you should be familiar with it because they show up, in many business contexts. But in general, the ending in e means the person that's receiving something, and the ending in or means the person that's giving something. So in the context of leasing, the lessee is the person that is using the asset and paying the rent on it or the lease payments, and the lessor is the person. Well, it could be a corporation that owns the asset, but that's renting it out to someone else. So make sure you understand the difference between lessee and lessor. Direct lease is the lessor is the manufacturer. So this is something that is fairly common in a lot of industries. When you have a company that, especially if you're selling, very large, equipment. A pretty good example would be GE and MRI machines. Like MRI machines are like $1 million each. So it's rare that a hospital will have the money to buy it up front. But the purpose of a direct lease is for a company that wants to sell their stuff, their products. And so what they do is they arrange financings themselves to so that they make the sale on that piece of equipment. Say I'm going to the example, I'm a company that makes MRI machines, and I'm going to sell an MRI machine to a hospital, but they don't have the money to buy it outright, and they don't have, and maybe they wouldn't be able to go get financing from somewhere else, like a bank or something. Then what that enables the manufacturer is to increase their sales. So lots of companies do that. Think of actually the best example would be car companies. Think like Ford, GM, Toyota, all these companies. You go to a car dealership and you might not qualify to get a loan from a bank to buy the car, but if you go to the car dealership, they might give you a leasing contract, even though you don't have a good enough credit to get it financed through on commercial terms at a bank. By the way, this is the reason why Nortel got in trouble. What they were doing was they were selling their stuff to telco companies in emerging markets that weren't that great, and so they were cranking their revenue and boosting their sale by selling their equipment and then having the next thing, which is a captive finance company, a subsidiary that was doing the financing. And so they would sell the big phone system switch thing for like a couple million to say like a new telco in Argentina. And the odds of that company staying in business weren't that great, but they were just booking the revenue, and then but they never received the cash. That's why I say the best way to look at a company is to look at the statement of cash flow, because you can pull these little tricks, these little shenanigans to kind of crank up the income statement. You can also do things with the balance sheet. But if you would have looked at the statement of cash flow for Nortel, even years before they started getting in trouble, it was obvious that something was wrong. You can kind of fake stuff in the income statement and the balance sheet, but you can't fake cash. So captive finance company would be, going back, say, to the example of a car company where there's a subsidiary that is essentially a financial institution that supports the parent company activities in other industries. So GE Capital is a great example of that, and GMAC for cars is another example. So what's the difference between buying and leasing? You should be pretty familiar with that by now. So if you buy the manufacturer of the asset, just you either you have already the cash for it, but that's pretty rare. So you probably the lessee arranges financing, usually with a bank. and you buy the asset from the manufacturer. So you both own the asset and use the asset. When you lease, what you do is you separate the property rights of owning the asset from the property rights of using the asset into two separate people. When you have a direct, when you just straight out buy something, then you both use and own. But when you have a leasing situation, the manufacturer of the asset sells it to the lessor, which owns the asset, and then a different person, a different company, uses the asset. An important thing for you to learn, and I'm hoping that you'll see that again in some other accounting course, and that's a problem that we have, I would say, fairly often at Sunbelt, is that the two things that people with CAs after their name have a problem with are the difference between amortization and depreciation. They get it wrong all the time. And the second one is the difference between an operating lease and a financial lease and how to properly account for it on the balance sheet. So let's talk first about what is an operating lease. It's a short-term lease. The lessor is responsible for the insurance, taxes, and maintenance, and it's often cancelable. The financial lease is a longer-term lease where essentially you're leasing the asset, but you're leasing the asset for most of its economic life. So an example to show you the difference would be if you think about a car. If you go, say, to the airport and you rent a car from Hertz for, like, you know, the weekend or a week, that would be a operational lease or a short-term lease. If you go to a car dealership and you get a lease where you pay per month for 24 months or 36 months or whatever, that would be a financial lease. You see, the difference is in the length, the amount of time that you have the asset. If you have the asset for most of its life, if you're leasing the asset for most of its life, if you talk about a car, 36 months, it's a majority of its economic life, and so that's considered a financial lease. In that case, a financial lease is closer to owning something, even though legally it's still leasing, but it's as if you own the thing. So you have to pay insurance, taxes, you have to maintain it, and so on. Generally, it's not you cannot cancel it. That wouldn't be true in the case of a car lease, but the penalties are quite significant. Some specific types of capital leases, tax-oriented. Lessor is the owner for tax purposes. You'll see later that if you have a multi-company legal structure where different entities have different tax rate, it's advantageous for the place where you have the highest tax rate to have that's where you own it, because you get the CCA deduction on a higher rate. And if you're either, say, a startup or you're in a jurisdiction where the taxes are pretty low, it's better to lease. A leverage lease, it's where the lessor borrows a substantial fraction of the cost of the leased assets. So you would have that quite a bit, say, in the airline industry. So, the price of a 777 is, I don't know, like 500 million or something like that. And so there are specific, there are lessor companies in the airline business. All they do is they buy airplanes, and then they rent them out to airlines. But they don't have the whole money, obviously, so they're gonna borrow a big part of the price. A sale and lease back. This is where you have a company that owns an asset, and they want to convert from owning an asset to leasing it. And so what they do is they sell it to somebody else, and then they lease it back. A recent example in current events would be Scotiabank. I'm not sure exactly what it's called, but It's the Scotia office tower. I think it's called the Scotia Tower or Scotia Place or something. I'm not sure, but the one in Toronto, that was in the news about 6 months ago, maybe a year ago. So Scotiabank owned that building, but to meet Basel III rules, what they did is they sold a building for $1 billion, and now they're paying rent on it instead. So it's where a sale and lease back is literally what the title says. You sell the asset and then you lease it. You still live in the same place. You still, use the same equipment, the same real estate. It's just that the title, who owns what, changes. The way that you account for leases, is the CICA 3065. You don't have to know that for a final exam, but that's the accounting standard that that you have to follow when you account for leases on financial statements. Financial leases are essentially treated as debt financing, meaning that what you do is, and you'll see later when I'm a little bit later in the course, one of the reasons for leasing in the past was that it was a way to, they still mention at the last point there, it was a way to put things off balance sheet. So if you're leasing something, you have to pay the payment. You have a legal duty to pay the leasing payments, but in the past that liability wasn't properly accounted for in the financial statements. So leasing was a way to put things off balance sheet, to kind of hide things in a way. With financial leasing, what the standard is that you take the present value of the lease payment and you put that as a liability, because these are the lease payments you're going to have to pay in the future. And then that same amount is shown on the left side of the balance sheet. So think of, actually, I think there. Here's the example. So there's 3 possible cases that we look at here. The first one is where you buy it. The second one is where it's an operating lease. And the third one is where it's a financial lease. Oh, by the way, another word for financial lease is capital lease. So what happens here? If you buy something, then that one is pretty simple. Right? You have an asset, which is a truck, for $100,000. Well, the company has another $100,000 in asset. But just look at what happens when you buy a truck. You put $100,000 as an asset. You own the truck, so that's a fixed asset. And then if you borrowed $100,000 for that, in reality, in the real world, you'll never get 100%. You'll always have to put some kind of down payment. Like, no bank's going to loan you money, zero down. Oh, that's actually true. The zero down, some car companies have gone with zero down, but it's pretty rare that you're able to borrow against an asset 100% of the asset's value. Usually you have to put, think of a house, a residential house that's 20%, I think, is the minimum. Well, you got 5% if you do the mortgage insurance, but if you look at this here, the full amount was borrowed to buy the truck. So you have the asset, truck, $100,000, and the debt, $100,000. Now, if you do an operating lease, then it doesn't show up anywhere on the balance sheet. It's going to show up in the income statement as an expense, right? I paid the lease payment. But we're just looking here at the balance sheet. So when you have an operating lease, there's nothing that shows up on the balance sheet. And that's a problem. When you look at a company, say I'm looking at a construction company, and I look at the balance sheet and it says, they own, say, 5 trucks, but I go to that company and I see that they really own 15 vehicles. How are these vehicles accounted for? That's the whole reason for having the financial leasing and how you account for it, is so that you're able to show on the balance sheet the fair representation of what the company has to operate. So the capital lease or the financial lease this is how you write it on a balance sheet. You say assets under capital lease, 100,000, but at the same time, you have obligations under capital lease. In other words, you're showing explicitly on your balance sheet the future liability that you need to make those leasing payments. And especially in the case of a financial lease, those leasing payments last for a very long time. So in a operating lease, you might just be borrowing the truck for 2 days or a month or a year. But in a financial lease, you're legally bound to pay those leasing payments usually for many, many years. So that's something that when you want the readers of financial statements to have a clear picture of what's going on, you got to include it. So that's the proper way to account for a capital lease or a financial lease. So make sure you know that, because you'd be surprised how many people have CA after their name. They don't understand that part. So what are the criteria for a capital lease? Now, these are the ones that are in the textbook. I'm not saying that accounting standards change all the time. So obviously, if you're a practicing accountant, you have to stay up to date on what some of these are. With our IFRS, like some of these standards and rules are in flux. So, but in the textbook, that's what you should know. That's how it's written. The lease transfers the ownership by the end of the lease terms. That's doesn't have to be all of those. It could be just any of them if one of the following criteria is met. So if you have one of these rent-to-own situations where you have a lease, and then at the end of the lease you're able to exercise an option to take over the asset, say for $1, then that would be considered a capital lease, because you essentially are going to have the asset for all of its life. Or the lessee can purchase the asset at below market price. The first two are really about the same thing. It's if you lease the asset and then there's some kind of option in the contract where you get to keep it at the end, that's a sign that that's a capital lease. The other one, that's probably the most important, is if the lease term is for 75% or more of the life of the asset. Now, the general concept is always true, but the actual 75%, I've seen that number change depending on jurisdiction and over time. Like, I'm not sure. I think CRA right now says it's 90%, but in any case, because of the textbook, just learn 75% because that's what it should be. That's what the textbook says. And the present value of the lease payments is at least 90% of the fair market value at the start of the lease. So that last condition would catch a lease on a car where, say, you're leasing the car for 36 months, and you're going to say, well, a car lasts 10 years, so it's not even half. But if you think of the way that a car depreciates, if you buy, say, a car for, I'll take a big number to make things simple, but if you buy a car for $100,000, 4 years later, you'll be lucky to sell it for 10, 15, or 20. And so even though you might only have the car for maybe less than half of its life, most of the value, the economic value of that asset could be at the front end. So the last two put together kind of go together, but just understand that in general terms, a capital lease is where you're leasing the asset for most of its life. So next thing is taxes. Remember that in this course, the main difference between 2504 and 2505 is that in 2504, we assume that taxes don't exist in a lot of cases to just make things simpler. In 2505, we look at how taxes affect almost every chapter that we look at. So a lessee, so the person that is operating the asset, can deduct the lease payments for income tax purposes under specific circumstances. The lease must be primarily for business purposes and not just to avoid taxes. So one thing that CRA goes pretty hard after is personal vehicles owned by business. And business owners, it's because business owners have really abused that part of the Income Tax Act for a long time. I mean, I saw once a retail store in the Maritimes where the owner was leasing a Mercedes and leasing a Mercedes for his wife and leasing cars for like 2 or 3 of his kids. Obviously, they weren't a valid business expense. So if there's lots of businesses where it's valid to use a car, but I'll tell you that when you're also putting in a car for the wife, that's when you're pushing it too far. Does not apply to conditional sales agreement. I'll be honest with you, I'm not really sure what that means. The lessee cannot automatically acquire title to the property after payment of a specific amount in the form of rentals. Now, this means that it's not one of these rent-to-own situations. Now, I'm not sure how you would handle it, because if it was a rent-to-own and it was a business asset, it would still be, by the spirit of the tax laws, deductible. So I'm not sure exactly how you would handle that part. Lessee cannot be required to buy the property during or at the termination of the lease. Again, this is a condition about the rent-to-own situation. And cannot have the right to acquire the property at a price less than fair market value. So all the last 3 is about rent-to-own situations, but we're not going to put something like that on exams, because the issue with anything that's tax related is that it's changing quite a bit, and a lot of times the textbook is quite far behind what the actual rules are. So when you go and you get a real job, make sure that you read the CRA, the Income Tax Act, and the interpretation bulletins, and all the technical news and all that stuff to make sure that you're up to date, because tax stuff changes all the time. But in general, what you have to understand about leasing and taxes is that it's got to be something for business. Right? You can't lease something that's a personal, like I own a boat that I use on the weekend to have fun with, and I put that as a business asset and deduct the lease payment. You're probably going to get caught on that. So let's get mathematical now, and let's start to look at leasing. Now, what we're trying to get to is the classic question that we're trying to answer in this chapter is, should I lease something or should I buy it? You probably have thought about that, and certainly in the case of a car, that's quite common. Do I buy the car and get a loan against it, or do I lease it? And also for real estate, do I buy a house or do I rent an apartment? So how do you decide which one you do? So we've got to build slowly the mathematical model here. So remember that anytime we do a cash flow analysis in this course, we look at incremental cash flows, meaning a cash flow that's going to happen if you make that decision and not going to happen if you don't make that decision. So in the case of leasing and versus buying, that we're going to see in a bit, when you pay a leasing payment, then don't worry about it, they're already gone. Oh, okay, there's, oh yeah, that'd be a good idea to close that, yeah. Remember that I told you before, times 1 minus t is going to show up in this course over and over and over again. All right, what's the purpose of times 1 minus t? Can somebody in here tell me? Yeah, you're getting close.
It reduces, like our lease payment reduces our taxable income. So the tax amount we don't have to pay on this, we basically save. So that's what we
Yeah. the short version would be that anytime you multiply something by 1 minus t, you're converting it from pre-tax to after-tax. Right? Remember, in the calculation of the average cost of capital, we have cost of debt, weight of debt times cost of debt times 1 minus t. It's because you're converting from pre-tax to after-tax. Anytime you multiply something by 1 minus t, you convert from pre-tax to after-tax. Anytime you divide by 1 minus t, you're converting it backwards from after-tax back to pre-tax. So this is something that shows up over and over. It shows up in chapter 10, shows up in chapter 14, shows up in 16, and 22. So this is a pretty common thing in this course. The loss depreciation tax shield, that's an outflow. Here's what's happening here. When you lease something, when you buy something, you get the CCA deduction. And so that reduces your tax payable. But if you lease something, you don't get that CCA deduction. And so when you look at the incremental cash flow between buying and leasing, when you lease something, you lose that CCA deduction. Because that CCA deduction, where does it go? To what person? To what? Eh?
The owner?
Yeah, the lessor, right? So when you have a leasing situation from the point of view of the lessee, the incremental cash flow is an outflow when you look at leasing versus buying, because when you lease, you don't receive that CCA tax benefit. Then the third one, which is really the most important one, and usually the reason why people do lease, it's because you don't have the huge cash outflow up front, right? Go back to the example of the hospital that wants that needs $1 million, an MRI machine that's worth $1 million. Well, if they bought it, they would have a giant cash outflow of $1 million right up front. But if you lease, you don't have to pay that big cash outflow. It's the same, let's say, if I talk about a car. You go and you buy a car that's $30,000 out of your pocket. But if you lease a car, you don't have that $30,000 that you need to pay up front, even though you receive the asset and you use it as if you had paid. So that's an inflow from the point of view of leasing versus buying, because you receive the asset and you get to operate the asset without having to fork out that big chunk of cash just at the beginning. There might be some other small amounts like maintenance, insurance, that kind of stuff. That's usually you got to read. You got to read the question quite carefully, because it's going to be written in the question. Well, if you lease this asset, you have to pay for. If you lease the asset, the lessor takes care of the maintenance. But if you buy the asset, it's going to cost you $500 a year in maintenance. So when you get to the final exam, you have to just read a question carefully to see, because I've seen it either way, like incremental to the side of the lessor, incremental to the side of the lessee. You just have to read the question, and sometimes it's there's $500 in maintenance whether you buy or lease the asset. Well, in that case, it's not incremental at all, because it happens whether or not you lease or buy, and so you don't include it in your incremental cash flow analysis. So here's a very simple example to get warmed up. So I'll use this this abbreviation quite often tonight, ATLP, after tax lease payment. So this is pretty simple. It's just a lease payment times 1 minus T. So the lease payment is $14,500. Tax rate is 34%. So the idea is that leasing payments are deductible, right? When you take all your income statement and you have one line that's leasing payments, so that's going to reduce your taxable income, and therefore your after-tax cost of the asset is whatever you pay, but less the reduction in tax payable because it's a valid expense. And so in after-tax dollars, you might be paying $14,500, but in reality, your actual after-tax costs for the leasing payment is only $95.70. It's similar to when we have cost of debt, say where you have, debt is at 10, you're paying debt at 10%, but the interest payments are deductible, and so if your tax rate is 40%, you're only really paying 6% on that debt. You're not really paying 10. It's the exact same concept here. The next one is the depreciation tax shield. So you have Saturn is trying to decide whether to lease or buy some equipment. The equipment costs $38,000, has a 3-year life, and is worthless after 3 years. The cost of borrowed funds is 8%, and the tax rate's 34%. One thing is when we do in leasing, when you do anything that has to do with present value, you're discounting at the debt rate, because you could use debt to buy the asset. So you don't discount at the WACC like other things we've done. But when it comes to anything that's leasing related, the discount rate that you use is the after-tax cost of debt. So the equipment can be leased for $14,500 a year. What is the amount of the annual depreciation tax shield in the second year if the equipment belongs in the 30% CCA class? So here's the idea. If Saturn bought it, then they would receive that CCA benefit. If they lease it, they don't. And so we want to quantify what that CCA benefit is. This is really just a Chapter 2 question. Remember that if you have a 30% CCA class, then in the first year you'll have the half-year roll, and so the kind of shorthand or compressed way of doing the CCA table, you could use the addition, subtraction, half of the half-year rule, like the 8-column version, but there's the 4-column version, which is a lot easier to do, where you just take the CCA rate and you divide it by 2 for the first year. It makes it a lot easier. So the CCA is $5,700, and so in year 2, the undepreciated capital cost, which is CRA's version of net book value or net capital assets. So the CCA deduction is 9,690 in the second year, and so the tax shield, the CCA tax shield in this case, is going to be the CCA deduction times the tax rate. Now, there's a shorter way of doing this. I'm going to show it to you now. The CCA tax shield in year 2 is going to be the UCC that you start with in year 1. Then it's going to be multiplied by 1 minus d over 2. Remember, small d represents the CCA declining balance rate. So this will give you the UCC in year 2. And then you multiply by d. So that would give you the CCA in year 2. And then you multiply by the tax rate. So the whole thing gives you the CCA tax shield in year 2. Well, that's already what's at the front there. So instead of having to do the full table like this, you could do it a lot quicker by saying 38,000 1 minus 0.30 divided by 2 times 0.30 times 0.34. You still get to the same place. Now, this formula, that's not something that's in the that's in the textbook, but I've been through this so many times that I just came up with it because it's a lot quicker to do a problem like that. If you had, let me show you something for a second. If you had, say, instead you wanted the CCA in year 4, then what you would have is because what this 1 minus D2 does is it reduces your UCC by the declining balance rate. You have D divided by 2 in the first year because of the half-year rule, but then the years after, it's just times 1 minus D. So if we want to know what the UCC was in year 3, all you would do is take 32,300 and multiply it by 0.7. Then you would get what it is in year 3. Then multiply by 0.7, you'd get what it is in year 4. Multiply by 0.7, you get what it is in year 5, and so on. Then you multiply by the rate, by the CCA rate. You get the CCA, and then you multiply by the tax rate to get the tax shield. So in general, the formula is this. Because for the first year, you're doing with the half-year rule, and then after that. Obviously, that's the formula if that formula is valid if t is bigger or equal to 2. Otherwise, you would just have when t is equal to 1. So that's a useful formula to use because you can just go through this. And if, say, you're asked for what is the CCA tax shield in year 3 or 4, instead of having to write out the full depreciation table, you just pound it through the formula right there. Okay, so now we get into the more comprehensive example, which is we want to look at all the incremental cash flows of leasing versus buying. So TransCanada needs new cars. The equipment cars would cost $10,000 each if purchased and would be depreciated at 40%. they would help the sales force generate $6,000 in additional sales per year for 5 years. No salvage is expected after the 5 years. Alternatively, the company can lease the cars for $2,500 per year, and payments are due at the beginning of the year. Now, that's something that's important to know about leasing, and surprisingly, I would say maybe a third to a half of students, when they write the final exam, they screw up that part. Leasing payments, typically, this is not set in stone. You might get some leasing contract where you pay at the end of the month. But think of, do you pay your rent on the 1st of the month or the 30th or 31st of the month? You pay it on the 1st of the month. With leasing payments are an annuity due. They're not a regular annuity. They occur at the beginning of the period. So when we use the different formulas, we'll have to use the annuity due formula. And then when you do it with your calculator, you have to set up your calculator in what's called begin mode. When we do a problem, I'll remind you how to do that. The other point in this example is, can somebody tell me which one of these cash flows in here is non-incremental? Which one of these cash flows is going to happen whether you buy or lease?
6,000.
Yeah. Right. This is one of these where it's just crud thrown in the problems just to maybe confuse you, but to illustrate the point that TransCanada is buying these cars for their salespeople, and the salespeople with these cars are going to go get $6,000 in sales per year. Well, whether you buy or lease these cars, they're still going to get that $6,000. So when you look at incremental cash flows versus buying and leasing, that $6,000 is irrelevant because it's going to happen whether or not you buy or lease. If you buy, you will have to pay the $10,000 up front. If you lease, you don't. So from the point of view of leasing, $10,000 is an incremental inflow from when you lease, because you receive the asset, you get to use a $10,000 asset, but you didn't have to pay $10,000. So in buying versus leasing, that $10,000 is a incremental inflow. Depreciated at CCA rate of 40%. If you bought those cars, you would receive the CCA deduction, the CCA tax shield. If you lease, you don't, and so that's an incremental. The present value of the CCA tax shield, that's going to be an incremental outflow from the point of view of leasing. No salvage is expected after 5 years. Well, that's kind of a way to step up the complexity of a leasing problem where you introduce salvage, but I have an example later with that. And the last one is the company can lease the cars for $2,500 per year. And so if you lease, you have to pay that $2,500, but if you buy, you don't. So the after-tax lease payment is $2,500 times 1 minus T. So when you lease, you have to pay $1,500 every, does it say every year? Yeah. So when you lease, you have to pay $1,500 every year. But if you lease, you don't have to pay the $10,000 up front. So that's an inflow. So you have an incremental inflow of $10,000 in year 0, and you have an incremental outflows of $1,500 each year for the life of the lease. And at the same time, if you lease, then you lose the depreciation tax shield, the CCA tax shield. So if we put these cash flows into a spreadsheet, there's a typo here in the textbook. That should be a minus right there. So payment shield, what they're calling payment shield is the leasing payment tax shield. So you pay $2,500, but you receive $1,000 in tax advantages from that leasing payment, and the foregone tax shield is that you don't receive you don't receive all those CCA deductions, and so you don't receive those CCA benefits when you lease versus buy. So that's an incremental outflow. And then you have the incremental inflow of when you lease, you don't have to pay the 10,000. So remember that when we do incremental cash flow analysis, avoiding an outflow is the same as an inflow. So when you want to know, do I lease or do I buy? Then what you want is you want to determine whether it's better to borrow the money and buy the asset or to lease it. So what you want to do is compute the net present value of the incremental cash flows of leasing versus buying. And the appropriate rate that you use is the after-tax cost of debt, because a lease is essentially a debt instrument on the balance sheet. So you wouldn't discount at the full whack of the company, you would discount at its after-tax cost of debt. Any cash flows that are leasing related, you use the after-tax cost of debt instead of the whack. So once you do the, it's a net present value calculation, but in this chapter, it has a special name called NAL, net advantage to leasing. So if the net present value of the incremental cash flows is positive, then you should lease. If it's negative, then you should buy. So the previous example that we were doing, the TransCanada car example, the cost of debt is 11%, so the after-tax cost of debt is 6.6. So if you take these cash flows, 7,700 minus 2,780 and so on, and you discount them at 6.6%, you end up with a net advantage to leasing of minus 199. And so should the firm buy or lease? Who's awake here?
Why?
Eh? Exactly. So let's do a comprehensive example. First, let me check the time. Yeah, I'll do one example, then we'll take a break. So you have a chemical company which needs a distillation unit. Unit costs $100,000, will be replaced in 5 years and worthless after that. So this is what's called a no salvage leasing problem. You'll see an example of with salvage later tonight. Yep. It's in class 8, so it has a declining CCA balance rate of 20%. The firm can borrow at 10.5, so that's its pre-tax cost of debt. And the equipment can be leased for $25,000 per year. And remember, unless you're told specifically, leasing payments happen in the beginning of the year. They're an annuity due, not a regular annuity. So first, what is the after-tax lease payment? So the leasing payment's $25,000. The tax rate is 30%. So the after-tax outflow is $17,500. Now for discount rate, you'll see R and K. I'm using K here just because we have the cost of debt is RD. That's a pre-tax cost of debt. And then you have to multiply by 1 minus T to get the after-tax cost of debt. So when we discount our cash flows later, we have to use 7.35%. Next, the next thing is what is the present value of the CCA tax shield? Now, there's not going to be this part. That's 1 plus k. C plus k, 1 plus k to the n. There's not going to be the second part here of the present value of the CCA tax shield because the salvage value is 0. Right? It says the equipment is worthless at the end of the leasing period. And so, present value of the CCA tax shield, 100,000. And don't forget to put this formula on your formula sheet for the final, because I guarantee you, you're going to use it at least once or twice in the final exam. So the present value of the CCA tax shield is $21,187. So that's quite, you wouldn't think it would be that much, but on a $100,000 purchase, when you lease it instead of buy it, you lose $21,000 in tax advantage. So you'll have to pay $21,000 more in income tax during the life of the asset. So next, what we want to do is before you do the net advantage leasing, you need to know the present value of the leasing payments. So we're in number 4 now, but the first step you need to do. So I want to know what is the present value of the after-tax lease payment. And what is that? Well, remember it's just a regular, it's just an annuity due. So it's the after-tax lease, not the after-tax, but present value of, it's the after-tax lease payment. So think of it as the payment in the annuity due formula. And then you have 1 minus 1 plus r to the minus t. Now this over here is very important. That's the difference. That little 1 plus r factor here is the difference between a regular annuity and annuity due. If you just had this part, just this much, then what you would be doing is finding the present value as if those payments happen at the end of the period. When you add this 1 plus r there, that's the annuity due formula. And so what you end up with is the present value when those payments happen at the beginning. Sorry, I'm using K right now. So what is the net advantage to leasing? It's the present value, well, it's the investment minus, so the investment, remember, is an inflow from the point of view of leasing, because this is, if you lease the unit, then you don't have to pay that 100,000. So that's an incremental inflow. Then you have to pay the lease payments, and you lose the CCA tax shield. So the net advantage to leasing is 2502, which is bigger than 0, obviously, and therefore you're better to lease the distillation unit than you are to buy it. Okay, so here's a good time for a break. All right, so it's 7:20. Let's continue. So now what I'm going to do is, I think you've figured that out by now. I prefer teaching by example than a bunch of theory slides. But just so I'll do it as an example, but just so you get the difference. When you have a net advantage to leasing with salvage, there's two little differences, and that's something you got to be careful about, because students, like I said before, I mark the final, so I get to see what people get right and what they get wrong. That's another thing that they have a bit of an issue here. When you have salvage, so what happens? At the end, if you have a salvage where the, in this case here, the equipment has a 3-year life, and after which time it's expected to have a resale value of 400. Here's the difference between leasing and buying. If you buy the asset, then you get to sell it at the end for 400. So you receive that 400 cash. If you lease the asset, you don't. And so this is an incremental outflow in the last year of the leasing contract. The other complication here is that it shows up in two places. The first, which I just mentioned, is you have the lost salvage, but at the same time, the other difference is when you look at the lost CCA tax shield, then in the formula it will show up there also. And because students think, well, in my present value CCA tax shield, I have minus the salvage value and I have it there, then okay, I've handled that salvage. But you got to remember that salvage shows up in two places: as part of the CCA tax shield formula and as the lost cash flow at the end. So let me show you an example. So first we got to figure out what is our discount rate. So if the pre-tax cost of debt is 7.5%, and the tax rate is 35%, then the after-tax cost of debt will be 4.875. So this is the first place here that the CCA tax shield, that the salvage shows up in the CCA tax shield. So you have what's the year? 3 years. So the first place that the salvage shows up is here in the present value of the CCA tax shield formula. So it's a little bit long. Just to make it clear, I'm going to yellow highlight it for you. The place where it shows up. So then when we want to know the present value of after-tax lease payment, so this is the after-tax lease payment is this whole thing. If you have the, I just spotted the, there's an error in the notes where it says 17,500, which is from the previous question, but the answer is still right. So the other cash flow you have to look at is present value of lost salvage. So in other words, if you buy the equipment, then you get to sell it for 400 at the end. If you lease the equipment, you don't get that 400. So that's an outflow, an incremental outflow from the point of view of leasing. Well, I'll put T here. But this is just the present value is future value divided by 1 plus R to the T. It's just a single cash flow. So the future value is the lost salvage, and you discount for T years, which in this case is 3. So as you can see, when you have a net advantage to leasing question with salvage instead of no salvage, the lost salvage shows up in 2 places. It shows up in the second term of the present value of the CCA tax shield formula, and it also shows up in the lost salvage. Lots of people think, oh, I've handled it here, so I don't have to handle it somewhere else, or they do this one, and so they're like, oh, well, I counted it here, so I'm not going to do that. But the correct way is that the CCA tax shield will not include that salvage, and at the same time, you will not receive the 400. So what is the net advantage to leasing? So you have an inflow for the investment. So if you lease if you buy the equipment, you got to pay $15,900. But if you lease the equipment, you don't. So that's an incremental inflow. You have to pay the lease payments. You lose the CCA tax shield, and you lose the salvage, the amount of money that if you buy an asset, you receive the salvage. If you lease an asset, you don't receive that cash flow. And so from the point of view of leasing, that's an incremental inflow. But it's an incremental inflow in the final year, and so that's why you have to discount it back to the present. So this is the most, actually not quite. There's 2 complicated math problems in this. There's the net advantage to leasing with salvage. The other one is break-even lease payment that we'll do in a bit. But that's as difficult as this chapter kind of gets. Okay, so continue what we're doing before. What if the lease payment was, this is going back to the example of, this example we had before, TransCanada and the cars for the salespeople. So here you had that the lease payment was $2,500. Remember, there's a typo in the book, that should be a minus there also. And so if instead you still have the cars are still worth $10,000. The tax shield is still, the lost tax shield is still the same stuff. But if instead you have the leasing payment is $2,000 instead of $2,500, how does that change the net advantage to leasing value? Well, obviously, the lower the leasing payment is, the better it's going to be to lease. And so when you lower the lease payment from $2,500 to $2,000, the net advantage to leasing goes from minus $199 to $1,126. So this is what's happening. If you look at the lease payment versus what the net advantage to leasing is, so we know that when the lease payment is $2,500, the net advantage to leasing is minus $199. When the lease payment is $2,000, the net advantage to leasing is $1,126. So, in the previous example, when the lease payment is $2,500, the net advantage to leasing is minus $199, but the net advantage to leasing is $1,126 when the lease payment is $2,000. What does that mean? It means that somewhere between $2,000 and $2,500, there's a lease payment where the net advantage to leasing is equal to 0. What that value is called is break-even lease payment. So at that break-even lease payment, do we have an example where they figure it out? No, okay. But at that break-even lease payment, the net advantage to leasing is 0, meaning that the cash flows from leasing and the cash flows from buying are identical. In that case, it really doesn't matter whether you buy or lease because it's costing you the same thing. So another way that you might see that on a final is it's going to say, at what lease payment are you indifferent between buying and leasing? In other words, when you're at that break-even lease payment, it really doesn't matter whether you buy or lease because it's costing you the same thing. So let's do an example of how to find that break-even lease payment. So we know that that's the formula for, right now there's no salvage. It says at the end of 4 years they will be worthless. So that simplifies that problem a little bit. So the net advantage to leasing is the inflow of receiving the asset but not having to pay for it, minus the present value of the after-tax lease payment, minus the present value of the lost CCA tax shield. Well, at the break-even lease payment point, the net advantage to leasing is equal to 0. So what you want to find is, if you rewrite that part of the equation there, you'll get that the present value of the after-tax lease payment, right, just bring that on that side, is equal to the investment minus the present value of the CCA tax shield. So once we find what is the present value of all the lease payments put together, then what we'll do is run the annuity due formula backwards to get what the individual payment for the years would be. And then that's going to be an after-tax amount. So then we need to convert it to pre-tax by divided by 1 minus t. So first, let's figure out what is PVA CCA tax shield. One thing I forgot to put, I'll just write it down here. The cost of debt is 8.5. The tax rate is 34. And so the after-tax cost of debt is 561. So the investment is 195. CCA rate's 30%. Tax rate's 34. So that's the present value of CCA tax shield. Running out of space here. So the present value of the after-tax lease payment is going to be equal to $195 minus the present value of the CCA tax shield is 54,372. So that's equal to 140,628. So now I know that that's not the break-even lease payment. That's the present value of all those break-even lease payments after tax put together. So what is the formula for the present value of an annuity due? So we know the present value of the after-tax lease payment. We want to find what are the individual leasing payments. So what you would do is rewrite this formula as, now remember that that payment here the after-tax lease payment has the role of the payment in the annuity due, and the present value of the after-tax lease payment has the role of the present value. So we want to solve for this here. So we know that the after-tax lease payment is 38,086. Now, one way you could have, you would have done this with the calculator is I want to make sure you know how to set that up on your calculator. Remember that when you do leasing, anything that has to do with leasing, it's an annuity due. So when you use your calculator, you could use the full formula. But if this is in a multiple choice thing where you could just use the calculator to go faster through it, you have to set your calculator to annuity due. And the way you do that is you go second, and then on top of payment, there's a BGN for begin. So you press that, and it will say end, meaning the payments are at the end. And then you press it a second time, or is it you? Oh yeah, I remember now. So you go second, and it will say end. Then you go second and set, which is on top of enter, and then it will say BGN. And then you reset the calculator, and you will have a little indicator on top of your digits that says BGN. That's annuity due, the payments at the beginning. So how would I do this right here using the calculator? I set my calculator to begin payments, which I already have. Then I would say the present value is 140,628. So that's PV. Then 5.61 is my interest rate. And 4 is N. And I compute the payment. And I get 38,08562, which is 38,086. You don't need to give me cents in a written answer unless it's the price of the price is like 461 or something. But in general, when you're doing certainly anything above 1,000, you don't need to put the cents on it. But remember, because you have annuity due, this in the formula, that 1 plus K is there. And then if you do it with the calculator, you got to remember to set it in begin mode. And then don't forget to set it back to regular mode by, once you're done your leasing questions, by going second begin, second set, and then it says N. And then you reset your calculator and you see that the BGN indicator is not on top of your digits anymore. Okay, so we're almost done on this question because what we have is the after-tax lease payment. So, but what we want is the pre-tax lease payment. And that's such a simple step, but that's a step that lots of students sometimes forget. So the lease payment is going to be the after-tax lease payment divided by 1 minus T. The after-tax lease payment is 38,086. And the tax rate is 34%. And so the final answer is 57,705. So let's look at, to kind of wrap it up, what's called a leasing paradox. If the lessor and the lessee have the same effective tax rate, then leasing is a zero-sum game. Right? Because whatever cash flow is lost in one side is picked up in the other. Right? If the lessee from leasing the asset doesn't receive the CCA tax shield, then the lessor is the one that gets it. So what we mean by zero-sum game is whatever disappears in one side reappears exactly in the same amount on the other side. This is not true when the tax rate of the two parties differ. So when the tax rates are different for the lessee versus the lessor, here's what's happening. The company in the higher tax bracket will benefit from being a lessor because they get the CCA tax shield. The CCA tax shield is worthless to the lessee because it faces a lower tax rate or might not have enough taxable income to apply the accelerated tax shield in the early years. So think of a startup which is losing money maybe in the first year or maybe even the second year if it's not that great of a business. Who cares about the CCA tax shield? Because even if you have the CCA tax shield, it's not a refundable tax credit. It's what's called a non-refundable tax credit. So if you have $2,000 in tax payable and you have a $1,000 CCA tax shield, that would reduce your tax payable to $1,000. But if you had a loss of $2,000 and you have zero tax payable, that $1,000 in CCA tax shield would just it would evaporate because it doesn't. Well, actually, it would create a tax loss carry forward. It's a little bit more complicated, but the point is that it makes more sense for a company that has a higher tax rate to be a lessor, and it makes more sense for a company that has a lower tax rate to be a lessee. The extreme example of that is if you're a nonprofit, it almost, you never say always, but I would say in 99% of cases, if you're a nonprofit, it makes more sense to lease something than to buy because you don't receive the CCA tax shield. So good reasons for leasing. You might reduce your taxes depending on how things are set up. You might reduce uncertainty. The best example of that is one of the reasons that people prefer leasing cars instead of buying it is they don't have the uncertainty of how much they're going to get at the end. Like if you buy a car for $30,000, you use it say for 4 years, you might be able to sell it for $5,000 at the end, you might be able to sell it for $10,000 at the end, or you might be able to sell it for almost nothing. You don't really know. And so what leasing does is it brings certainty to what your cash flows are. You don't, when you think of buying an asset and using it for a while and then you salvage it at the end, a big part of how much that asset's going to cost you over its life is whether you're able to get a good price for it at the end or not. When you lease, you don't have that uncertainty. You might have lower transaction costs, so it might cost you more to set up bank loans and that kind of stuff. Like an example of when I got a mortgage for my company, I have to have a notice to read a financial statement, which costs about anywhere from $500 to $2,000 to do. But I'm like, I'm a professor of accounting and finance. Why would I pay somebody else to do my financial statements? But that's a thing in the bank loan. So some of the transaction costs might be higher doing one or the other. There might also be some restrictive covenants. Remember, covenants are conditions in a debt contract, like a bond or a bank loan, that you must maintain some different measures. So it could be a measure on you need a certain amount of net working capital, or you can't take on any new debt without the permission of the senior lender, those kinds of things. So when you lease, you wouldn't have that problem because you're not picking up new debt to buy an asset. And you may encumber fewer assets than secured borrower. Bad reasons for leasing. In the past, one reason why companies would lease is because it makes the balance sheet look better, especially when you have these financial lease, these capital lease, where you really have, you get to use something that's, maybe you have a $100,000 truck, but you don't get to put it anywhere on your balance sheet. But you legally bound to make those payments. So in the past, leasing was a way to kind of hide some of your fixed asset costs in a business. Another bad reason for leasing is 100% financing, meaning that especially with cars, these 0% down car leasing deals. In general, remember that in Chapter 16 we talked about what is an optimal debt-to-equity ratio for a company. It depends on the industry, the certainty of cash flows and all that, but typically anywhere from half debt, half equity to a quarter equity to 3/4 equity, somewhere in that region is healthy. When you have something that's 100% financing, you're really leveraging yourself up an incredible amount. So that's a very risky situation from the point of view of the capital structure of a company. And leasing allows you to acquire an asset without having any equity in it. Most lease, you actually need to put some kind of down payment on it, but there are some leasing, especially manufacturer leasing, where they're trying to sell you whatever they're making, and it's the same company that's doing the leasing. They'll give you the credit to finance the whole thing, but that's not necessarily healthy for the company to get into that much financing. There's other reasons for leasing. That's in big corporations where they have only rules on how much capital expenditures you have per year, per division, or per country, or whatever. What some middle managers would use, they use lease because it doesn't create that. Instead of having to pay $100,000 to buy a piece of equipment, they just say have like a leasing payment for like $10,000, and that doesn't get caught in internal controls of a big multinational corporation. Obviously, that's not a good reason for choosing leasing. But not to say that that's not being done out there. All right, so this is it for tonight. This is for the new material. I have one more example of the break-even lease payment. So I'll take about a 5-minute break now. If you want to clear out, there's no new material for the rest of today. So let's see what time it's. Done pretty right. Well, I've done a whole hour in advance. So, I'll take a break until 8:05, and then I'll do one more example of break-even lease payment. But there's nothing new that you haven't seen before. All right, everybody's here, so let's continue. I'll take the full. Just take 2 minutes. Yeah, so everybody ready? Okay, so there's only one example, but it's a big one. Because what I have here is a break-even lease payment that has a salvage in it. So it's about as complicated as it gets. Okay, so first we need to figure out what the after-tax cost of debt is. So it's 6.27. Next, we need to figure out the present value of the CCA tax shield. That one's pretty ugly. S5. Remember that when you have salvage in a a net advantage to leasing or break-even lease payment, it shows up in two places. It shows up in the present value of the CCA tax shield, and it shows up in the present value of the lost salvage. Salvage is 50,000. So I know that net advantage to leasing is the investment minus the present value of the after-tax lease payment minus the present value of the CCA tax shield minus the present value of the lost salvage, and we know that all of this is equal to 0 at the break-even. And so, the present value of the after-tax lease payment, that's going to be equal to, bring that to the right side, everything else stays the same. So the investment is 440,000. The present value of the CCA tax shield is 109,714. And the present value of the lost salvage, well, that's 50,000. And it's discounted back. That's a cash flow that would have happened at the end. And so you have to discount that back 5 years. And so remember when I told you that, where did I put my... The lost salvage, remember, shows up in two places. It shows up here in the CCA, present value of the CCA tax shield formula, and it also shows up here. So don't think that if you put it in one place, you're done with it, because it shows up both. And it shows up in those two places. This cash flow is that you literally would have, if you own the asset, you literally would have received that 50,000 at the end. And that one is that your CCA tax shield, you wouldn't get the CCA tax shield for after you sold the asset. So we know that the after-tax lease payments, all of them put together, discounted as an annuity due, will be equal to 293,396. So what we want to figure out now is what is the individual after-tax lease payment. And so it's the remember that it's the annuity due formula solved for the payment. So you have present value after tax lease payment. If you don't put this here, this is the part that's important, and that factor 1 plus k shows up there because it's an annuity due instead of a regular annuity. So the present value of the after-tax lease payment is 293,396. Another mistake that I see, not so often, but when you do the annuity formula, it's k at the top, but it's 1 plus k at the bottom. So it's 0.0627 at the top, but it's 1 minus 1.0627 at the bottom. So be careful. There's a 1 here, but there isn't at the top. So the present value, the after-tax lease payment is 66,024. And so the lease payment, remember, just when you multiply by 1 minus t, you go from pre-tax to after-tax. When you want to go from after-tax to pre-tax, you divide by 1 minus t. And so the final answer is 100,036. The end. So that's it for today. I will see you next Tuesday, and that's the last class for the year. And remember that group assignment 2 is due at the beginning of next class.